In today's video, I'm going to share with you the real tax strategies of American billionaires and show you how you can apply these same strategies in your own financial plan. Hey everybody, I'm James Knoll, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. Now, we often see headlines of this billionaire doing that or this billionaire doing this. Well, here's the thing. We spend so much time reading about it and looking at it and saying, oh man, must be nice to do that. The reality is a lot of these strategies are available to you and me. It just comes down to understanding how they work and when it might be applicable to your own plan. So in today's video, I'm going to share with you 4 strategies that you can use to save taxes in the same way that billionaires do. So what's the first thing that you can do to save taxes in the same way that billionaires do? Well, number 1 is be an owner. What do I mean by that? Well, when you look at the US tax system, ordinary income and wages, they are taxed differently than capital gains. I'm going to show you why that matters. But if you look over here to the left, what you'll see is the current 2022 ordinary income tax brackets. They range from 10% to 37%, meaning as you earn a wage, so you're getting a paycheck or you're going to work and money's coming into you, well, depending on your income and depending on your tax filing status, the more that you earn, the higher the taxes that you pay. So what you see is if you're in the highest tax bracket at the federal level, you're paying 37 cents on the dollar. So each dollar that you earn, 37 cents of it is being paid in federal taxes. Now that's not to mention whatever state tax brackets you might be in. You might be in a low income state or no income tax state, or you might be in a high income tax state, at which point maybe 50 cents on the dollar that you earn is going to be paid in taxes. Now that's how you pay taxes when you're earning an income, you're earning a salary. There's a different way if you own a company. If you own a company, you don't actually pay taxes until you sell it. If you look here, what you'll actually see is the capital gains tax brackets. And these capital gains tax brackets, the first thing you'll probably notice is they're lower. Instead of ranging between 10% and 37%, they range between 0% and 20%. So as you look at this, number 1, if you own a company, you don't pay taxes on the growth, you only pay taxes when you sell it. And number 2, when you do sell it, you're selling at a lower tax bracket than you otherwise would have with income being earned from that company. So when you hear about these CEOs and these founders saying, hey, I'm taking a very low salary, understand something. It's typically not being done out of the goodness of their heart. It's typically being done because they're saying, look, I could take a salary here and pay maybe 37% taxes on it, or I could just own the asset and I could participate in the growth, pay no taxes as it's growing, and then a lower tax bracket when I actually sell that asset. So when people are saying, oh, look at the CEO, look at this founder, takes such a low salary, understand this is why. They want to be taxed like an owner, not taxed like an employee. A lot of people talk about Warren Buffett in this way. In a 2007 interview, Warren Buffett talked about how his secretary pays higher taxes than he does. Really, this is a little bit misleading. But when you look at Warren Buffett, he only takes $100,000 as a salary. Now, he did not build his $100 billion net worth because of his $100,000 per year salary. He built it because he takes a small salary, but he grows the heck out of his assets. So those assets that they're growing, it's tax-free growth. He wouldn't actually sell or he wouldn't actually pay taxes until that's sold. Now, if you look at the people in his office, I think the average tax bracket they were paying was about 33%, which is higher than the capital gains limits. So number 1, it tells you they're earning a pretty healthy income. But number 2, it's not that they're paying more taxes in Warren Buffett. He's certainly paying way, way more when you factor in the growth on his assets and dividends and everything else coming in. The difference is they're paying a higher percentage because they're being taxed as an earner. They're paying taxes at the ordinary income bracket, whereas the CEOs and founders, they're paying taxes on the growth of their assets once they actually sell. So what does that mean for you? Do you have to go fund and own the next Berkshire Hathaway like Warren Buffett? Do you have to go create the next Apple or the next Google? No, but you should own them. The beautiful thing about the American stock market is you can own the same exact asset that Warren Buffett does. You can own the same exact asset that Tim Cook does. You can own the same assets there by owning stock. When you own stock, you are an owner. The beautiful thing about stock is when it appreciates in value and you sell it, you're paying taxes at those lower capital gains rates as opposed to the ordinary income tax brackets that you would pay with a salary or other types of ordinary income. So if you want to be like Tim Cook, buy Apple. If you want to be like Warren Buffett, buy Berkshire Hathaway. It's not a recommendation, it's just saying we too can be taxed in the same way, but to do so, we need to build up wealth in stocks. So as you're looking at this, building up a great portfolio of stocks, building up a great portfolio of equities What that allows for is it allows for us to be taxed at a lower rate on the appreciation of those assets as opposed to paying a higher rate through earned income. The second strategy that American billionaires employ to pay much lower taxes is they just don't sell their stock. So you could take this a step further. We talked about number one, okay, well, be an owner, because if you sell stocks, you pay less taxes than you do as an employee. Well, take that a step further and just don't ever sell the stock. And you ask, James, how do you do that? Well, the strategy is called buy, borrow, die. 3 simple components to it. Buy, borrow, die. Number one is you buy stock. Now, in this case, you either buy it, or in this case, maybe you found it. So Mark Zuckerberg, for example, he founds Facebook, now Meta. He didn't really buy that stock as much as he created it, and so that wealth has been created. Well, if Mark Zuckerberg wants access to that stock, he could sell a bunch of his Facebook shares, and what he would do is pay a huge amount of taxes on that because the gains are quite high, or he could borrow against them. So after step number one, which is buy, or in his case, found the company, step number 2 is borrow. Now, if you borrow money against anything, this could be borrowing money against the value of your home through a HELOC. This could be borrowing money against your life insurance policy. This could be borrowing money against your car. This could be borrowing money against your stocks. You don't pay taxes when you borrow money. Now, you don't get a tax deduction typically as you're paying some of that money back, but that money comes to you tax-free. So far, what they've done is they've bought a company or founded a company. They borrow the money against that company. What that allows them to do is live off that money tax-free. Again, if you have your stocks as collateral, the bank will say, here's money that you can live on, and this funds your everyday living expenses. Well, at some point, the third step is die. Now, that sounds kind of blunt, but really what it means is this. Let's assume that you have a founder who has a $100 million stock portfolio. Well, let's assume that they bought in at $1 million. Well, if they sold all their stocks, they would pay taxes on $99 million. That's a really large tax bill. So if instead of doing that, they said, you know what, I'm just going to borrow, let's say $20 million from the value of my stocks. So I own $100 million, I'm borrowing $20 million tax-free, I'm just going to live on that. Well, what happens is when they die, when any of us die, there's a step up in basis. So if they were to sell their stocks while they're still alive, they pay taxes on the difference between $1 million and $100 million. It's $99 million of capital gains. Yes, it's taxed at a lower rate, as we discussed, but it's still a lot of taxes. So they say, what if I borrow against this, live on that tax-free, and when I die, there's what's called a step up in basis. So that $1 million cost basis jumps up to a $100 million cost basis, if that's still the value of the stock. So when the heirs sell it, there's actually no capital gains taxes. Now, there'd probably be quite a bit of estate taxes in that instance, unless there's a lot of estate tax strategy going on there, but there wouldn't be any capital gains taxes. So the strategy here is you buy the stock, you borrow against the stock tax-free, and then you die so that your heirs get a step up in basis. And this is somewhat common. Now, obviously, the third part of the strategy, die, that's the part of the strategy that you want to push off as long as possible. Just saying if you can keep borrowing and living on that, it's going to be deferring the tax bill that you owe. And Elon Musk has recently been in the news with this. As he's looking to finance a potential sale of Twitter, well, it wasn't done through saying, I'm going to go sell all my Tesla shares. I think he sold some to create cash for this. But he also took out a loan from some major banks using his Tesla shares as collateral. So he said, look, here's all the Tesla shares I own. Instead of selling them, I'll use this as collateral. The banks lend him money, and then he uses that to purchase Twitter if that goes through. So that's just one example that's been in the news recently. Now, this can be done, but if you do it, you want to be very careful. Because another example that's been in the news recently was this same strategy, but this strategy gone wrong. John Foley is the founder of Peloton. Peloton took off. It took off in a big way, and the share price really launched to a high level. Well, what he did is he borrowed against a lot of his shares to buy a nice home, to buy a bunch of stuff. And what he did was he told the banks, here's my Peloton shares. I want to borrow against them. Well, that works really well when the value of your shares stays stable or even keep growing. But take a look at what's happened to Peloton stock over the last 12 months. This is not what you want to see. Now, I don't know the details of John Foley's loan and his arrangement with the banks, but let's assume, just for the sake of simplicity, that he had $100 million in Peloton shares. And he went to his banks and said, look, I have these shares with $100 million. I would love a $30 million loan. So they give him that $30 million loan that's collateralized by the shares. They say, look, if you don't ever pay this back, we have your shares. We'll have to liquidate and pay back. Well, what happens? If his shares drop in value by 90%, that 100 million real quickly becomes 10 million, but he still owes the bank 30 million. So that's the risk of this strategy is it works great. If those shares keep growing or stay stable, you can live on that tax-free loan. But as the shares fall, the bank is going to require you to post margin calls or collateral arrangements. And they're going to say you need to post more collateral because the value of this is falling. So this is when it can backfire in a really bad way and force you to sell if you're not structuring this properly. So this isn't exactly what happened in John Foley's situation. There's a lot more details to it than that. But what you can see is you can see the risk of the strategy of what happens if the value of that collateral falls. Puts you in a really tough position. So if you are going to use that strategy, you want to make sure that your investments are far more diversified so they don't run the risk of dropping 90+%. But that is one way that billionaires access funds tax-free. It's not through selling their shares, it's through borrowing against them. Now the third thing they do is they use tax-free accounts. Another recent example of this is Peter Thiel. And what he did is he put a little bit of money in his Roth IRA years and years and years ago, and that little bit of money has turned into $5 billion. That $5 billion in his Roth IRA, which means that is all available to him tax-free. Now this kind of created an uproar, but really what that is that's the same exact type of an account that all of us have access to, whether through direct contributions or backdoor contributions or potentially Roth 401k. This is an account that everyone has access to. Now you're probably not going to have an investment that grows from a couple few $1,000s to $5 billion like he did, but you certainly have the ability to fund this to let the growth happen tax-free so that you can live on the tax-free income as it comes out. So the more growth you can get in Roth IRAs, the more tax-free income you can expect for yourself in retirement. But that's not an account that's reserved for the elite or reserved for only people with hundreds of millions of dollars. That's an account that all of us have access to, and it's an account that can be a huge part of your financial plan. The fourth thing that they do is they give to charity. Now, a lot of these wealthy people, they make a lot of money, but they also give away a lot of money. Now, as you're doing it, don't just give indiscriminately. Now, give to the causes you care about, give to the things that you're passionate about, but do so with a strategy. Whether this is things like qualified charitable distributions or donor-advised funds or private foundations or charitable trusts. When people that are very wealthy are giving, they're not typically just giving out of their pocketbook, out of their checkbook. They're creating sophisticated tax strategies to say, how can we use these special types of accounts to maximize the impact of our gift? We know where we want to give. How can we do so in the best way to maximize the tax deductions from this? This is what wealthy people do really well. So as you look at all these things that billionaires do and that really, really wealthy people do, the good news is all these strategies are available to you and to me. It doesn't take having multiple millions or even billions of dollars to have access to this. It just takes strategic planning. So if you're listening to this and say, this is really interesting, what are some of the strategic planning points and how can I actually implement them? Check out this playlist above where I walk through the tax strategies that are available to you and I. Once again, I'm James Knoll, founder of Root Financial. And if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.